Good morning, Noble Gold. Micah Haints here, Senior Sales Associate. And today I've prepared something we haven't done in a little while. Look at all the various markets. We're going to cover some charts for both gold and silver. We'll talk about stocks as well and what's been going on there with correction the last few days. And so we haven't done one of these in a while. I used to do these with Colin every couple of weeks where we would update everybody on what we're seeing in the charts and what we think happens next with gold and silver. And without further ado, let's jump right in. So we'll start off with, update. We'll start off with gold, of course. Let's take a look at the mama of the precious metals. This is a close-up look at the last few weeks. Now we do see that gold was able to get up to a high just shy of $4,400 back toward the end of October. Now, after getting to that point, it actually did drop into the high kind of 3,900s, but we have a triangle of support here. It's been tapped, looks like 3 times now. And this type of formation suggests as long as we stay within the support band of the bottom of that triangle, that we should get a bounce. Now, $4,200 would be that level that we want to clear to show that we're actually jumping off and breaking out and starting that next run higher. Now, in my opinion, we probably have to test 4,000 maybe another time or two, but this formation will resolve to the upside. We just need it to coil, stay within the framework of this triangular support band, and then we'll break out once we get up above 4,200. Now let's take a little bit of a zoom out with this next chart. And what we see here is that there's actually a broadening wedge pattern in this chart that we've hit the top of and now pulled back from. And again, we're kind of suggesting maybe that this is like a larger zoomed out view, that we could go a little bit lower. Longer term, it's still going higher, but we could actually have a little bit more leeway to break down. If 4,000 from the previous formation doesn't hold, we could get to something like 37 or 3,800 in the worst case scenario. Now, what I think we will spend time doing over the next couple of weeks or maybe the remainder of the year is more or less allowing these formations to play out. This is a consolidative phase. We will either have again, a sideways churn or a pullback and test of support on the lower end of these two charts. But once we do reconcile this consolidated phase with the breakout to the upside, this next chart shows you that I'm looking for something probably in the $5,000 and $5,500 range for 2026. So you can take my money right now. That's where I think we go in 2026. Of course, I don't control the market. I wish I did. But if you look at this even bigger picture view of gold, we had a breakout above this ascending trend pattern, came back down and retested the top end. Last week we had another big rally, and now we're just testing the top band of that rising channel, that rising trend channel. So we could again test the bottom of that, maybe 4,000, 39, 3,800. But I think once it resolves, we'll be in that $5,000 to $5,500 range for 2026. Now we'll take a look at silver next, of course. Silver being my favorite metal. This is a closer up of the volatility that we've seen. So from the end of August at $38, we rose all the way to 54. We did have a steeper correction down to the 48, 47 zone. But then last week at the beginning of the week, it actually rallied all the way back and tested that $54 range again. Now, some are suggesting it could be a double top, meaning like when you hit that resistance level at 54 twice, you have to correct pretty significantly to the downside. And what this chart notes is that we do actually have a very big stretch from the 200-day moving average. If you look over the course of this chart, price will rise and then come back to test the 200-day moving average. And because we're in a bull market and prices are constantly rising, the 200-day moving average is actually turning up, and it is moving up as well, but it takes longer for the 200-day price average to actually catch up to the price unless the price drops to meet it. So there is a chance that we actually do retest the 200-day moving average. That would be in kind of a worst case scenario. But I took a closer look at silver this morning, and it actually could be forming a mini cup and handle. Let's take a look at this next chart. Now, this would be sort of the bullish case where we hit 54 once. That's the left side of this cup. And then we crashed all the way back down to 48 rather dramatically and rather quickly. Now that we hit 48 again early last week, we went from 48 to 54, $6 move in just 3 days. So we now have the right side of that cup. What has been forming just this week, end of last week and this week, is now the handle formation, which is the right side of that drop and the mini handle. And if we were to get back above 53 to 54, and that's only a couple dollars away, we could actually resolve to the upside. And couple and handle formations, of course, are extremely bullish, and they always resolve with major breakouts and new all-time highs after that. So this is just what I'm seeing in the short term. This mini cup and handle could be what we see as opposed to a double top. I'm actually encouraged this might play out this way rather than having to go back and meet the 200-day moving average. But on this next one, this is the zoomed out big picture cup and handle, and it gives you a better sense of what happens once a cup and handle resolves. You've got the big cup, you've got the little handle. Once you break up out of that handle resistance line, then you shoot straight up. Now, this puts silver in my $200 to $300 an ounce target. There are a couple of ways that we could get there, the faster or the slower way. I still think we get there somewhere between 2028 and 2030. And like I said, it's probably something like a $300 silver with $10,000 gold. That would be roughly a 30 to 1 on the gold to silver ratio, which is what I'd like to cover now. Next, everyone talks about the gold to silver ratio. Let's have a look at this chart. So this is a long-term chart showing you the price relationship or the price ratio between gold and silver. We have had a couple of all-time highs in the last 5 years. It was 120 to 1 briefly in 2020, and it was at 104 to 1 back in April, March. So now that we have gone from 101 to 80 to 1, which is where we're at today, it's showing that it actually wants to break down. So the gold to silver ratio breaking down is actually a feature of the price of silver shooting up a lot higher or at a lot faster rate relative to the price of gold. That's obviously what we've seen since September. But the actual next phase of this would be a very steep breakdown from the 80-ish range into probably the 50-ish range. And I think that that'll happen for some time next year. And so we're keeping our eyes on this. It's still really, really cheap. Silver is extremely cheap at an 80 to 1 compared to the historical average. My view is we will get to something like a 30 to 1 by the time this bull market runs its course. And that's why I give clients a target of $10,000 gold and roughly $300 silver by, call it 2028 to 2030, where this cycle might peak. Now that we've covered the metals, gold, silver, and the gold to silver ratio, let's take a quick commercial break and we'll come back and look at some other relevant charts.
Talking to people today about their retirement accounts. Sir, excuse me.
Yeah.
Do you have a retirement account?
Yeah, I've got a TSP from my old government job.
How's that doing?
I'm forgetting about it. I can't contribute to it. There are fees to get the funds and the investment options are limited, so the money's just stuck.
How about a gold IRA?
I can do that?
Absolutely. You can roll it into a gold IRA and you have all the same tax advantages as a TSP, but with more flexibility. And you can put physical gold and silver in your retirement account.
I'm taking control with Noble Gold Investments.
Your retirement, your rules. No.
All right, now that we're back, we'll cover some other interesting charts. This might seem like a little bit of left field, but I want to talk about Japan. People are going to ask, why Japan? Well, Japan's really relevant. Let's just give a bit of context. Japan has, for the last 30 plus years had some of the lowest lending rates in the world. They were actually some of the first to experience or experiment with quantitative easing and with yield curve control, where the government's printing money to buy bonds to keep interest rates artificially low in order to stimulate the economy after they had a massive stock market and real estate crash in the late 80s. Well, something that's gone on for the better part of the last 3 decades is something called the Japanese carry trade. So in Japan, you could borrow money at something like 1%, half of 1%, and you could invest that in American stocks where you are annually averaging something like 5, 6, 7, 8%. So borrow at 0.5% to make 6 or 7. You pay back the interest on the loan and you book those massive gains. Well, what's happened now is Japan's economy, for the first time in 6 quarters, is now in negative or contractionary, recessionary territory. What that means is they're having significant economic slowing, to the extent that the Japanese government just this week has announced a $110 billion relief package to stimulate the economy. Now, printing or creating $110 billion of stimulus spending is very inflationary, and that's why people do not want to hold long-term Japanese bonds. Let's go to the next slide. We know from covering bonds and bond yields over the course of the last year on the show together, that when you sell bonds and the price of the bond goes down, the actual interest rate goes up. So the yield or the interest that's yielded from holding that bond goes up. So as less people want to hold them, those that do continue to hold them expect higher interest rates or higher returns for holding onto them. Now, because of the $110 billion of stimulus spending to get the Japanese economy out of what looks like a recession, that would be viewed as inflationary by the bond market, and people are selling bonds now. They don't want to hold them longer term because the power of the yen will not hold if they're printing that much money. So what's happened now is the interest rate being paid on Japanese debt is the highest that it's ever been. Now that has caused, again, this unwinding of the Japanese carry trade. This is something we covered when it was relevant at the beginning of the year. Then it kind of turned into a thing that everyone forgot about again. But with rates surging to the extent that they are, the debt in Japan is now becoming much more expensive than it used to be. That means that people who borrowed in Japan at 0.5% or 1% to invest that in American real estate or American stocks and clip that big that spread in the margins of what they could make versus what the debt cost them. Well, that's unwinding. Now they're selling their US stocks to pay back their debt in Japan, and that actually is having a downside effect in the stock market. The last couple of days, we've had 2 down days in a row, and let's have a look at some of the charts showing you the action that we're seeing in the US stock market. Now, of course, tech has been leading the way for several years. This is a megaphone pattern, basically the shape of a megaphone. We've hit the top, we've hit the bottom, we keep bouncing between. Well, we did overshoot and actually broke out and did a blow off top. We broke out of the top of that megaphone pattern resistance line, and now we've closed back down below it, which suggests it could be a false breakout or an overshoot that's now breaking to the downside. So too early to tell, but where this would put us for some time in the middle of next year is something like a 40 to 50% drop in the NASDAQ. So of course, although they've led the way on the way up, they could very well lead the way on the way down. The NASDAQ is down the last couple of days, and it is showing a lot of signs that it could be topping here, and we could finally be rolling over into a long expected tech stock correction. But this weakness in the US stock market is not actually isolated to the NASDAQ or to tech or to AI. Let's have a look at this next chart. and take a look at industrial. So the Dow, so a little bit of a different formation. This is a rising trend line. We have also tested the top and the bottom. So the resistance and the support, the floor and the ceiling of this line, this rising trend line. But now we are on the cusp of breaking down below critical support, which would also suggest major failure in this space. And we could see a correction again alongside the Nasdaq. Measured move on the Nasdaq chart suggests 40 to 50% totally possible over the next 6 months, but we'll have to see. It's still early days and we want to monitor the charts going forward. But what this suggests, and of course this has been a big topic, let's go to this next chart here and just talk about the context that we're in. I mean, we have a lot of fear and not a whole lot of selling off. I mean, these markets are down, let's say 5% over the last week or so, but we've already moved into extreme fear territory. That's part of what's intriguing about this market is we go from extreme greed to extreme fear with just these few percent moves. It tells us that we're in a very emotional market. We're in a very toppy market potentially, and we haven't even seen major corrections, right? We haven't broken down in the Dow chart. We're only starting to break down, but we haven't gotten anywhere near the lows that Nasdaq chart suggests. So if we are actually going to get a sizable correction, 20, 30, 40, 50% in the stock market, which I think is more than likely. It's just about when and how it goes down. Well, if we're already in extreme fear territory after a 5% sell-off, I'm afraid like we're going to have probably a negative reading. It could go below zero. And of course, extreme fear will lead to probably even more selling and a cascading effect. And a capitulation in the U.S. stock market. But let's zoom out and take a look at this next chart. Instead of thinking of it in sentiment terms or emotional terms, let's just look where we are today compared to other bubbles like 1929. So this is a number of months that the bubble has gone on. We see that we're in the all-time high territory. We've actually exceeded valuations from the 1929 bubble, from the 2000 dot-com bubble, and from 2008. Now, they say that history doesn't repeat, but it rhymes. Well, I actually think a year from now, we'll be looking back at this chart and saying it actually rhymed pretty darn well. So that doesn't mean that the stock market tops today and rolls over tomorrow when we get to that 50% sell-off in the next couple of days. These things do take time. You'll see that finding a bottom in an actual bear market can take many months, and they're not without their counter trend rallies or dead cat bounces along the way. So I look at this chart just for sake of comparison. Where are we today versus where we were in 1929? Again, history doesn't repeat, but unfortunately, I think it does rhyme. And our stock chart analysis from the other two big indices suggest to me that we're probably on the brink of going on the downside through the next few months. Now, this next chart, let's take a look at this. And this is actually a lot of what people are talking about today is Bitcoin and the crypto space in general, but we'll focus on Bitcoin exclusively. Now, this is a multi-year chart, goes back to 2021. You can see you've had a lot of volatility, but we have essentially seen a drop from about 126,000 in Bitcoin to the low 90s. We've actually technically broken that major support line, that blue diagonal line at the top. And if we do break that, we've got gaps to fill. You could go as low as $75 or $75,000. That'd be the next most likely target from the high 80s, low 90s. You could actually retest that middle blue line at around 55,000. And if that were not to hold, then you could easily retest the 2022 low of about 15,000. Now, what makes me very bearish in terms of Bitcoin is that we know it's only been around about 15 years. Okay. Gold and silver have been around for 5,000. It's stood the test of time. It's been through every crash, every recession, every currency reset. Bitcoin, however, has actually not been through an actual bear market. And what we know from the 15 years or so that cryptos have been around is that it actually trades in tandem with almost a perfect correlation, a high 90s correlation coefficient with the Nasdaq. Let's have a look at this next chart. which shows you the correlation. So they literally trade together 92% of the time. And the low in the middle of this chart was in 2022. Okay, so we went from a low in 2020 after the COVID crash to a new all-time high for both tech stocks and Bitcoin in 2021. Now, the crash of 2022 had the NASDAQ drop by 40%. Bitcoin crashed by 85%. And so the correlation is there. It is positive. They trade together, but it's almost like the returns, both up or down, or the losses in Bitcoin are actually magnified. And you can get like a 2 times multiple from the Bitcoin price action. And so if they trade together, and as per my previous chart showing you that the NASDAQ's actually in a megaphone pattern and probably looking at a potential 30, 40, 50% crash, what does that mean for the price of Bitcoin? Well, if this chart is any indication, it says to us that their strong correlation means that they will go down together. But not only that, but you'll actually have magnified losses to the downside in Bitcoin. So with that, let's take a quick break from the charts and do one other commercial break. See you soon.
When I first decided to invest in gold, I was a bit nervous and unsure how to start. Luckily, I found Noble Gold Investments. From the very first call, they made investing easy. No pushy sales tactics, no gimmicks, and no confusing free silver offers with hidden fees. Just honest advice tailored to my needs, giving me confidence every step of the way. If you're new to gold investing or want a partner you can trust, visit noblegoldinvestments.com.
Okay, welcome back. So we've looked at gold, we've looked at silver, we've looked at the gold to silver ratio, we've covered US stocks, we've covered the Japanese economic situation and the Japanese carry trade. What I want to finish with here today is a conversation about how gold and silver ultimately are a position to hold because you want to manage risk. Okay, we will make an insane amount of money in the precious metal space. They already are the best performing sector of any asset class for the last 2 years. But the reason for that is that the flight to safety only comes around every so often. There's a certain environment, there's a certain type of economic condition that makes the ownership of gold and silver not only the safest, but the most profitable. We're in that now. We're in a structural bull market. We have many years of this left, but ultimately I want to underscore that gold and silver are ultimately a way of managing risk from your stock portfolio, your 401k, your exposure to cryptos, or your exposure to the dollar, right? The dollar's down as well this year, and we are now just looking at what could potentially be the beginning of a major US stock market correction. But that's not the only risk out there. We've got the Japanese carry trade, we've got Bitcoin rolling over, we've got the AI bubble worries, housing and both commercial real estate seem to be on a knife's edge as well. We've got private credit companies blowing up, similar to the way that they did prior to the 2008 crash. You've got auto loan and mortgage delinquency and credit cards delinquencies at all-time highs, even worse than at the lows in the bottom of 2008 in the great financial crisis. AI leading to accelerating corporate layoffs, job losses, and a weaker real economy. And you've got global economic contraction, Japan, Canada, much of Europe. So all these things lead to the idea that you want to protect yourself from any kind of economic shock. Okay, we could easily see something happen in the financial markets that is, a black swan, something we don't expect. We are looking at the charts and thinking they could go down, but something could happen at any time that really does kind of highlight why you need to have some of your wealth in a physical, tangible asset class. Physical gold and physical silver are not in the bank. They're not in the dollar, and they're in a counter-cyclical asset class, which means when all this stuff comes to fruition and we do get a recession and we do get a stock market crash, that flight to safety where everyone runs from stocks and into gold, we have a absolutely massive capital rotation and many, many years left in the structural bull market because of the environment that we're in. So at the end of the day, it all comes down to hedging, and doing so in a proactive manner. Don't wait for your 401k or your IRA or your TSP to get hit in the next correction. You want to take proactive approaches to protecting your wealth in a format that's outside of all these risks. So I welcome you to call me, Micah, Senior Sales Associate at Noble Gold Investments, but you can talk to any one of my other colleagues. We have a great sales team. We're not just salespeople. We own this stuff. We live and breathe this stuff. We believe in it. We put our money where our mouth is. So the number to reach me or any of my great colleagues, 877-646-5347. And again, Micah Haints from Noble Gold. You can call me anytime. I'd love to chat with you. 877-646-5347.